The three major risks or concerns we have in the U.S. market today are derivatives, geopolitical, as well as high levels of debt on the consumer. Now, we do address these issues when looking at our portfolio, both on the companies or businesses that we own in the portfolio, as well as companies we would like to own. In saying this, we look for companies that are in excellent financial condition with strong balance sheets. This enables these companies to weather short-term impacts and come out stronger in the long term. We also look for companies that generate a significant portion of their revenues from outside the U.S. For example, one of our top holdings, Citigroup, generates over 50% of their revenues from outside the U.S. This lightens the dependency on a single strong economy, being the U.S. economy, as well as a single strong currency, being the U.S. dollar. Lastly, we can't undervalue the importance of diversification, as well as sticking to our strict investment discipline and methodology. It's difficult to put us in a style box because over short market cycles, we're either going to be outperformed by deep value or aggressive growth. We see ourselves as an all-weather manager. We seek to outperform our benchmark, being the S&P 500, over relatively long periods of time, that being rolling 5 and 10-year periods. And we seek to do so in different market environments and over different market cycles. If we had to sum up what would attribute to our long-term performance of outperforming the S&P for every rolling 10-year period since inception, it would have to be the application of consistency. And that consistency comes on many fronts. It's consistency in our investment discipline and process. It's consistency in keeping that investment discipline and process geared to the long term, knowing that short-term underperformance is inevitable. It's also consistency within our research team, keeping our analysts and adding to that analyst team over time, adding talent where we feel we need help or we need to be better at. It's consistency in our culture of the firm, in the way we do things, keeping a culture that is humble, keeping a culture of learning. We learn from our past experiences, but we also learn from our mistakes. An example would be outside our research hall, outside the research analysts, we have a mistakes wall, where we call it the wall of learning, where we keep the top certificates of all the stocks that have not done well for us in the past, where we've learned mistakes from our investments. So we really have a culture that is consistently trying to learn, trying to be humble, and keeping with our investment process and discipline over time. We aren't too concerned with our high weighting in financials. Actually, our financial holdings are some very good businesses at reasonable valuations. When we look at financials, we don't take a top-down view. Therefore, it's not a top-down portfolio construction bet that creates a high weighting in financials in the portfolio. In actuality, it's a bottom-up process, where our bottom-up research has unveiled these great investment opportunities to own excellent companies and own them for the long term. Now, it comes to the interest rate question. In an interest rate increasing environment, are we particularly concerned? Well, we look at interest rates as it will affect all the companies within our portfolio, not just financial holdings. We look at interest rates as well as we look at other factors such as commodity prices, oil prices, inflation, unemployment. These are all factors which affect our analysis in understanding the companies that we own. So we should not lose sight of just looking at interest rates and how it will affect the financial holdings. Now, in looking at the financial sector, it's a false belief that all companies within the financial sector react in the same manner to interest rates. It is also a false belief that all companies within the financial sector are highly correlated. And that's an important thing to note, because a lot of people look at portfolios and say, well, the weighting in financials is high, and believe that it's going to react in a certain way to certain economic data. AIG is a holding that has been in our portfolio for the most part of the past 35 years. We've known Hank Greenberg for over 30 years, who's the former CEO. And there's really very few CEOs that have added the type of value he's added over such a long period of time. Our conviction in AIG stems from not only Hank Greenberg being the former CEO, but the current management, the current senior level management. Their ability to navigate the company over long periods of time has been extremely impressive and effective, both from a strategic level in strategic implementation, as well as from a tactical level and implementing their tactical resources. The HSBC American Growth Fund is managed by the same investment team, applying the same investment methodology and process as our flagship fund, the Davis New York Venture.